with another session, which is also the most asked session by a lot of startup founders. We are doing early stage company valuation, a very, very basic workshop to just get you started on the process of what you need to think about when you have started your own startup and are interested in understanding how to go about with the process of valuation. With me, I have Shefali Chhachhi, who is a brilliant person, first of all, and she has a long, illustrious career as a marketer working with very, very big brands. Her mission right now is to help is to foster sustainable growth for people, companies, and brands. She is the co-founder and partner at Hearth Ventures, and she is a visionary leader. This is Hearth Ventures is India's first venture fund for sustainable lifestyle sector, focusing on creative, cultural, and circular economy. This fund supports new age entrepreneurs utilizing technology, design, and marketing to build scalable and profitable enterprises in art, culture, design, heritage, ethical fashion, and decor. I don't think we could have got a better speaker or better expert to get started on our workshop for understanding what are the key elements to value your business. Shefali, over to you. We're very excited to have you here.
Thank you so much, Teresa. And I'm hearing what you're saying, and I'm saying, oh my God, she's talking about me. I don't know whether I'll be able to live up to that expectation because in many manners of speaking, I consider myself a shuru and not a guru, right? So just a little anecdote for everybody. It's like I was trying to get my partner Vinayak, who's my partner at Hearth Ventures, to join me in this workshop, and he's got 15 years of private equity and angel investing and VC experience, right? I've got like 5-6 years of angel investing experience. He says, no way am I joining a valuation workshop. It's too vast a topic. And there is no way I'm going to do this. And then, so the question is, why do I choose to do this? I think 2 or 3 reasons. One is that, the opportunity to meet some gifted founders, who are, purpose driven and to start having that conversation around valuation and maybe just dial up on some of the key issues in my own direct experience that I'd like to share, with the group, so we can start the deck. Thank you very much, Teresa, for having me on this RISE platform. It's a great platform, and I would like to thank the Aspire for Women team, Aspire for Her team as well, who's doing some exemplary work on driving the momentum on building entrepreneurship among women. So thank you.
Thank you, Shefali. I forgot to do the shout out for Aspire for Her. Thank you very much, Subha and Madhura from Aspire for Her, for giving us the speaker for valuation. I've been on a hunt to find experts in last 1 month. So yeah, thank you, Shefali, for rectifying that. Anthony, do feel free to share the deck and put me in the backstage so that Shefali can start the session.
Great. So for all the attendees, welcome once again. One quick logistical issue is that I am totally dependent on Anthony for navigating the slide deck. So you're going to be possibly hearing my request to sometimes to move the deck, to move the slides. And the reason there are slides are, I think, more to navigate the conversation, more than anything else. If possible, have a calculator handy on your phone or a pen and paper handy. And what I'd just like to know from the group is, sorry, my apologies, I think I'm lost, is how are there, at what stage are you at? What kind of, could you talk a little bit about, your startup? Very, very briefly, if you, almost like if you were pitching to me, what would you say? Maybe you can put that in the chat. And it allows me to get a glimpse as to what's going on. Who all are the attendees? What's your profile? And we could move to the next slide, Anthony. So if you are here, then most possibly you are fundraising, and hopefully it is fun. For most founders, this is not the fun part of their journey at all. They'd rather just focus on doing what they do, and to kind of be raising a fund is, it takes a lot of resilience and tenacity. Uh, if you can share your name and your brief description about your startup and what are you pitching, it gives me a sense as to the kind of early stage, enterprise that you're building. And if you are at zero revenue or how much, or, a little revenue. So most startups ask this question, can you help me find investors and can you help me raise money? The question really is that, is that the right question when they're seeking mentoring? And for very early stage startups, perhaps the approach is a little different. Maybe, Anthony, if you can move to the next slide. The right question really is that, can you help me build a stable, successful, and sustainable business? It's not so much about fundraising. Fundraising is a means to an end, but the end itself is to build the business altogether. And my understanding on all the entrepreneurs who are going to be watching this session in the future also is that a lot of you are purpose-led. Being purpose-led, the right question is how do I really build a sustainable and an enterprise that can make a change, that can make a difference in society. So that also keeps you energized and resilient to bring about that change. And a lot of startups, we know that about 98% of startups don't get the funding they need. The 2% who do get the funding they need do have to, work super hard in terms of being able to achieve, their mission, vision, and the needs of and also the expectations of the investors who have invested in them. So that is really the context in the background. And if you go to the next slide, then the intention on why you started perhaps is the first thing I'd just very quickly touch upon. Because if the intention is to make the change, and have that clarity on what you're trying to do over a period of time, everything else falls in place. And because there is so much, in India, there is such a significant amount of buzz around the startup ecosystem and crazy valuations. Founders sometimes get into whatever they're building for the wrong reasons. And it is not about, cutting up the golden, the goose, to kind of pull out the eggs. It's more about, how do you actually nurture a baby into the growth? Maybe move to the next. My request is to move to the next slide. This is the one, yeah. So at a very early stage, you have the advantage of getting a lot of love showered on you by all sorts of players. As a baby stage, this is a bit of a busy slide, but I'll just kind of spend a minute on this, which is, you are trying to build, and these are called seed and pre-series A stage. You're trying to find those few customers who regularly use your product. And you're also trying to quantify the retention on how sticky what you are building is, right? And maybe we move to the next slide, Anthony. So to the previous slide, sorry. So at that very early stage, there's a lot of, and 10 years ago, there was a lot more love. Today, there is a little less love, I guess, because, a lot of the early stage investors have also learned a lot from their mistakes. So they are less forgiving, and there's less experimentation, or let's say the experimentation is dialing down a little in today's day and age. I'll touch upon this a little bit more. But at very early stage, when the startup is just a baby, you are taking a big risk on investing all your time and energy in it, and so is your investor, whoever's looking for investing in. So that it's high degree of love, which also means taking a high degree of risk. Both are love and risk are siblings out here. And we, for the next slide. And therefore, what happens is there needs to be a high degree of, I think cognition on what are the investors' needs are in terms of the risk vis-a-vis the reward. So, for example, the risks can be so many. When an investor is looking at your business, for you, of course, it's a high degree of risk as well. And when you hear investors talk about this, it's as equal for you, actually more for you, because hopefully at very early stages, you own a larger portion of the company and the investor only owns a small fraction of the company. So whatever is true for the investor is true for you. And these risks are: is the product good enough? Is there really a big market around this product? Is the management quality good? Is the execution going to be great? Other risks like financial risks. Is the company going to get reasonably good amount of funding to be able to sustain itself? What is the competition, and how well is this startup going to compete in the market? And there are and regulatory risks, etc., right? So the psychology or the mindset of the investor is important to understand. Is they are looking at more. They're not looking at as much about increasing pleasure as much as decreasing pain. And here I just want to quickly touch upon the power law, because investors, angel investors, early stage investors, etc., they might be prolific investors. They might be investing in many startups, hoping a few give them the returns they need, right? So earlier, that approach to spray and pray was a lot more forgiving and a lot more generous. But increasingly, capital is being deployed towards far more deserving candidates on the back of all the maturity and learning. So this whole area of reducing pleasure, reducing pain, which is reducing risk, vis-a-vis, increasing the pleasure of the reward at the end of the whole cycle, needs to be thought through. So somewhere in the valuation, and we'll talk about why we should not even think about the word valuation here a little later. We have to just consider these factors. Next slide, please. So what is of value, right? And you already know some of these things, right, innately. Yeah, there are certain factors like team experience. What is being valued is you, the founder. At very early stages, there's not really much of a revenue. So what is being valued is you, your experience, and the runway that you have as a founder or a bunch of founders. And therefore your character, the quality of your character, the confidence you have in your product and your customer, in your ability to execute, and the coachability. So a lot of angel investors and early stage investors, they see value in not just investing their capital, but also how to unlock their own network wealth, for the founders to succeed. They see a lot of satisfaction coming from both capital appreciation, but also the ability to use their own networks and their innate knowledge. So your coachability becomes a very important aspect also in whether they see the value in working with you for the next 3 to 5 years time. And then there are other factors like how solid and how robust is your thinking on your business plan. And we'll touch upon business plan, maybe double click on this a little bit later, but not in very detailed scope, because it's a separate workshop altogether on how to really create a robust business plan. And what are the capital requirements you have coming out of that? How much money do you really need, right? So it's not about valuation, it's about how much money do you need, and then you work backwards. And how does this compare to, and for the investor, it's always about the investors getting bombarded with many opportunities. How does this compare to other opportunities? And you will never know what the investor's perspective is in terms of what they are seeing out there, but it's good to get into their step. And most importantly for investors are short-term. It's a short-term relationship, right? 4 to 7 years, 8 years, maximum 10 years. Is there an exit strategy, and do they see a clear exit coming through? Next slide, please. So, overall, the net point here is that the beauty does lie in the eye of the beholder, and the beholder here being the person who's looking at investing in your business. As passionate founders, we all think that our business models are unique. And of course, there are various tangible and intangible factors to keep in mind, right? So I'm just taking a small segue, looking at some of the comments that have come in. And I'll just, before I go further on this point, nice to meet you, Swapnil. And I'll read up a little bit more about the business that you do. Thank you. And so therefore, I'm just going to very quickly narrate, right, on what are the factors, say, an investor might look at in considering saying, is this worth the value, or what do I value this business at? One is, of course, industry benchmarks, your past performance or any pilots, if any? How real are your projections? Have you actually thought about multiple scenarios in building your business plan? Have you considered what ifs? If this happens, what happens? If that happens, what happens? How realistic is this? An Excel sheet plan, or is this an academic exercise? How was the model built up? Have you built up the model by the number of customers you need to get to that revenue? And how realistic are your pricing, assumptions? And have you been able to demonstrate the ability to price and I'm talking about, this is agnostic to B2B, B2C, any sort of a business or any sector. These are general factors. If it's a B2B business, do you have any contracts? Those contracts have value, and those are tangible value creating opportunities. If it's a D2C business, how robust is the unit economics? Do you have customer retention? If you've served about 500 customers also, are you retaining back 200 out of them? Which means there is a certain stickiness, and these early adopters have found something and they want to keep coming back to it. It gives a sense as to confidence on what the runway roadmap might look like as you scale up. So this is broadly, and of course there are other factors like IP. Do you have intellectual property which is differentiated? How unique is your value proposition? You can move to the next slide. And there is a saying in our, when investors look at saying, are we betting on the horse or betting on the jockey? And for very early stage entrepreneurs, we are inevitably betting on the jockey, not on the horse. The horse is still in little fetus stages, but the jockey is there, and the jockey is showing you, this is what my horse is going to become. So that was there just to make that comment. Let's move to the next slide. We've kind of talked about this. The context is changing a lot, right? 10 years ago, what was true for early stage founders of various types of businesses, and I'm not even talking about tech. Tech is a very different ballgame now, but many of us who might be doing, especially businesses with a strong social purpose, they may be technology supported, but they are not tech startups, right? The market environment is much tougher. There is capital available, but that capital is becoming a lot more, let's put it this way, becoming a lot more selective about where to put that money in. And this is happening across sectors, it's happening across stages. But for early stage, even more so. So the thing here is that, so what is really changing in the context is that there is investor maturity. And so the need for your own resilience to develop a thick skin, and do all the hard work, that investors will buy into. And I look at it this way, when there's a lot of buoyancy in the market, a lot of startups kind of just make it through, right? Because they are kind of riding the back of that. When the buoyancy is low, it needs a high degree of patience and resilience. So it's like an inverse curve, in terms of how to look at this. Let's move to the next slide. And here's the most important point to be made in this session, which is the first time investment doesn't necessarily go by valuation. It goes by starting with what is required for the business. What are the funds you need to take off? And the other question is, what is your intention? What is your appetite for dilution? And we'll touch upon all these points also. The first part, which is what are the funds you need to take off, is a function of saying, have you really thought through your business plan, which is based not an Excel sheet exercise, but actually based on some market test and learn. And it's based on some live experience out there. मतलब थोड़ा proof of concept है. And how much can you dilute is a function of your own internal ambition, capacity, but also some sense of realism on saying, I've got a slide coming up a little later on dilution. We'll talk a little bit more about that. I hope everybody understands that term. But the first set of investment that you come in, the first set of investors who come in, that investment is there to test things. Now, you might have done some own self-funding, and you might have funded through friends and family, but you might need more capital than what your own friends and family network and you personally are willing to invest in that startup. But so therefore, when you go out there, that investor is putting in money to test things, but not necessarily to prove the entire potential. So testing has more risk and hence might have higher equity. So it's it all depends on how much is that risk. If there is more proof available, there is less risk. So the pricing at what you can kind of value your round at changes, right? Of course, valuation becomes even more important in subsequent rounds. But let's talk about what to think through in seed rounds. Let's move to the next slide. And this is my belief. I've seen this in a lot of companies I've personally invested in. This is the best capital for early stage founders are paying customers, because it also means no dilution of your own equity and ownership of the company. These paying, if you can build and of course, easier said than done, building a great product which can be found, and many times the capital is needed so that your product can be found more easily. But can we build something that is also has embedded in its product value the ability to be found, and people talk about it, and that sense of people talking about it, and therefore one customer leading to another, and that sense of customer wow, and so this I won't emphasize further on this point, but for early stage founders is the best source of capital. Next, please. And in the context of just putting this, these bunch of slides, I was thinking about all these factors actually impact valuation a lot, right? But each one is a separate session altogether, be it in terms of thinking through your company structure and, how investment rounds and further set of investment rounds might change that. Business planning is possibly the most important aspect uh, of, of valuation, if we may call it that. Risk management, and a whole business planning includes actually these factors like risk management and strategy, marketing, value proposition development. We can kind of push that out and say there's a lot of conversation to be had on that. And then fundraising process itself, the whole thing about term sheet, SHA. So all this I'm not covering, pass for documentation, what is the entire fundraising process from term sheet to final close. And of course, I'm not covering in detail the textbook stuff on DCF, other valuation methods. I have a request, Anthony. Could you also keep me on time? Because I know, okay, so checking at 2:26 p.m., we've covered a little bit of a background. Now I'll talk about 2 or 3 important aspects. Let's move to the next slide. So I would say if I was a startup founder like you, I would first start with actually the end in mind, which is saying, and the end is, of course, a lot about what do I want to build as from a business point of view, and where do I want to take this. Of course, being completely clear about why you are doing what you're doing and where you want to take this at what stage. There is, for example, a certain founder who says, I'm not going to be doing this for the rest of my life. I'm in this for the next 7-8 years, and then I hope to sell out and then get on to doing something else that I want to do. There's another type of a founder who says, I see myself running this for the next 50 years. And even if my stake keeps reducing, I see building a big, large organization in which maybe I have a 5% stake, but that 5% is of value, is of a lot of value, right? So one part of it is your own need on saying what is, and you have a sense of what that end. Nobody can predict the future, but you have an intention on where you want to take this. The other aspect of this is whoever your investor, and there are different sorts of investors, right? What is their outlook? But irrespective of the type of investor, the one important factor for any investor is it's a short-term relationship, and they are looking at saying, I put in an X amount of capital today. What is my exitability? How do I, in 5 years or 6 years or 4 years, when I want to sell, who do you, I think I'm going to sell it at what value am I going to sell it at? If today I invested in this business and it's being valued today at 0 revenue at 2 crores, can I sell it at a value of 30 crores or 10 crores in 5 years time, which means that whatever capital I've invested appreciates by that much, by 5 times or 10 times. So I'm just kind of, so that exitability is a very, very important aspect. And I want to just make sure I've kind of got this one, there are 2-3 other elements of this which I want to just make sure I've covered. So just to give you an example, which I'd kind of written down. So if I've given you 1 crore at a valuation of 10%, and which means that I'm in the value of the business is at 10 crores after I put in the money, which means that pre-money, the value is at 9 crores. And we'll talk about now how does that come about to be, how to even see how to get that first type value. But I want to start with end objective in mind first, and then we'll move to working backwards. So if I want to exit at a 5x return, I would like the business to see it at a valuation of 50 crores, right? I entered in a 10 crore post-money valuation. Post-money means after I've invested the money in. And at the end of 5 years, I want to exit at a 5x, which means my 1 crore has become 5 crore. So I want to exit at a 50 crore valuation. And so this is the first factor to keep in mind, saying that when I'm presenting a certain opportunity to an investor, what is the current valuation and what is the future expected valuation we are looking at. Let's move to the next slide and we can answer more questions if the need arises. Just excuse me for a minute. And you might have heard of this, but a lot of these startups are also, and we ourselves have made investments where we've invested in early stage startups, but with a reasonably good stable revenue base for 6 to 12 months time, where you can do, you can value the company based on a certain revenue multiple, and this changes by the type of category. So B2B SaaS is a higher factor vis-a-vis, say in today's day and age, a D2C consumer company's got a lower factor of revenue multiple. But say if you are doing about 10 lakhs or 5 lakhs of business a month, which means you're doing 60 lakhs of revenue in a year. So we could value the business at about 4 to 5x and say that today, if it's doing 60 lakhs a year, then in about 5 years time, it can become, in about 3-4 years, it can become about 3-4 crores of business. And therefore, I'm valuing the company today at that. So this is another way of doing that, which is just give me a second. I just need to drink some water. So that is another way to kind of look at the valuation. And this can be applied largely by those startups who have some stability. But if you don't have a revenue base at all, if you are almost at zero and you've just got an idea and a concept, then this is not the right method to do the valuation of. Are there any thoughts or questions? Maybe we come to that later, but just park your thoughts or questions as we come along. And I also sometimes think that when it comes to raising your first round, you sometimes have to forget about, valuation and you got to think more about saying, this investors, how much capital do I need and how much am I willing to dilute? So if we go back to the previous slide, now I want to stitch the two back together, suppose you have a business that needs an initial amount of capital for the next 1 year of 50 lakhs of rupees, right? Now, for that 50 lakhs, are you willing to dilute? How much of your business are you willing to dilute? The normal rule of thumb is that for very, very early stage, try diluting less, because the lesser you dilute, the more runway you have to dilution later. For example, if you're diluting 30%, it's very expensive. It's a very expensive one for you. If you're diluting at 5%, 6%, it is cheaper for you, because it means that you're valuing the company at a larger you're valuing your company at a larger, I was just looking at the comment made by Teresa, amount. But there are also times when you are looking at getting that first investor, because the first investment is the toughest one, right? It's a make or break. So you might get a very early stage investor coming in and diluting at a 25-30%, which means you're giving away 30% of your business and you're valuing the company at a lower value. But that small amount of money that you're raising can help you build the business further to start then valuing it at a higher rate. So you're almost using that first investor coming in, because 80% owning 100% of zero is zero. But if you're owning about 70% of something substantial that you've built over 2 to 3 years time, it's still of a larger value. So you got to kind of keep that perspective in mind. So Umesh, your question is, when does evaluation make sense for long haul deep tech startup? Example, something that takes 3 years to reach MVP. Let's park that question and we'll take that up as we go along. We hope to kind of get to that and answer that later. So, and then value calculation change when at initial. I need to understand Felician's question a little better, but we'll pick that up later. Let me talk about dilution a little bit in the next slide. I think the next to next slide. Okay. I think most of you are aware of dilution, but I think it's important to just kind of get everybody on the same page. The screen is a little small for me, so I'll try to explain the numbers which are written there. So I'm asking for an investment of, say, I'm the founder, and I'm asking for an investment of 20 lakhs at a pre-money valuation of 1 crore. How much stake does the investor get? Could you help me answer this as you go, maybe in the chat box? So the answer is, it's not 20%, it is 16.7%, right? Because for pre-money valuation is 1 crore, you've added 20 lakhs, so post-money valuation is 1.2 crore, and the 20 lakh investment therefore is 16.7% of the business. The first point. The second point is that suppose you are two founders who start with 50% each, which is 100% of the business. Sure, Swapnil, noted that. The total number of new shares that you have to issue. So suppose we earlier had 50 shares each and 100 shares. So the total number of new shares you have to issue is, you need to issue 20 more new shares. And the dilution of the founders therefore goes down to 83.2% divided by 2. So those are the numbers. So I put Vinayak's and my photos out there. Is basically 40, what's that number out there? It's 41.6%. Yeah, that's the number. So it's gone down from 50% to 41.6%. I hope this is, as an example, illustrative example, is clear to everybody. I'm just going to touch upon this. It's a very basic issue, but it's just important to kind of lay that down. And let's move to the next. And maybe I want to kind of go through the next bunch of slides quickly so that we can spend more time on the questions, because that's a better conversation. Let's go to the next slide, please, Anthony. I spoke to somebody who's worked with us, with one of our startup founders, on valuation. And, we were talking about this whole, a lot of the times when you don't have traction, you don't have a lot of revenue, and this might answer your question, Umesh, a little bit, is, so what do you actually use to do a valuation? And you sometimes use multiple methods and then you arrive at a heuristic. You kind of arrive at some kind of an estimate on saying 4 different methods, what they're giving, and somewhere you arrive at a place where you feel comfortable, right? But this is an good method, I would say. So firstly, you build a profile of your business. Are you a B2B or a B2C business? What industry, specific industry? Where are you located? What is the stage of development? What is the profile of your target customer? And that also means the size of the market, and not just the size, but the segment you're serving. What's the size of that segment? And what is the competitive profile? So first you build the entire profile of your business. Once you've written this down, you find other startups that match your company's profile and have recently raised funds. And you might find those examples. Sometimes it's difficult to find examples. For example, I work a lot with circular economy founders, and I don't find too many precedents in India, right? So we have to use I don't like to use USA examples. I think they're not great, benchmarks, but I try to use other parallels, and there you need to apply some imagination on saying this could be the X of Y sector, some of a different sector. So you put your benchmarks on who are you benchmarking against, in terms of your fundraise, and it also functions the stage you are at, right? At that stage that you are at, and the industry and the sector, what are the benchmarks? So that's the most important aspect. Now it's theoretical, but actually when you actually roll up your sleeves and put it down, then we have to all apply our mind and see what are we comparing, who are we comparing ourselves versus. If they have been funded, their data is available on on Crunchbase, CapTable, TechCrunch, etc., which might be accessible to somebody who's subscribed to that. So you need to find somebody who subscribes to those databases. For example, I subscribe to Traxon only because we are an investment firm, but you might find an advisor or a CA who might subscribe to some of these. And then you sit down with your CA and you go to the MCA website and you pull down their documents which are publicly available. And then from that information, you can very easily decipher what have X been valued at, and therefore can I be in that benchmark. So that's called a transactions comparable method. And you can also then figure that, okay, I think I'm better at or not so good at. So the deltas or an up and down adjustment on saying if so-and-so was valued at 10x on revenue multiple, or, in your case, if you're building something that takes a 3-year MVP, 3 years to even reach MVP, you have some precedent against which you're looking at such examples in deep tech. And I'm not a deep tech expert, right? So I will not be able to comment further on this, but the principles remain the same, saying that you might have a precedent and say, looking at so-and-so, but then you also have to look at yourself and saying, am I that type of a founder? Am I better? Am I comparable? Or what is it that I need to do on my own capabilities that will help investors drive that confidence in me? So this is one way of doing this. So I wanted to touch upon this. We can move to the next slide. And then there's this whole thing of pre-revenue and post-stable business. How do the factors differ? So let's move to the next slide. Again, a content-heavy slide, but basically early stage valuation. Let's just touch upon that. So they basically rely on the assessment of your potential of what the future value might be. So there is every company, every investor has their own set of scorecard. I'm not sharing my scorecard here. I just felt it might have been relevant. But if you look at the scorecard, but broadly there are the same aspects, right? Saying founder quality, market size, is there a future growth potential? What are the current indicators on the ability to execute for very, very early stage? For example, in the example given by Umesh, where you don't even have a basic MVP in place. Do I believe in this founder's tenacity and ability to execute? There is a Canadian VC called Loyal VC. They are alumni. They are part of our alumni at INSEAD. And what they have developed is a psychometric technique whereby they assess founder capability. Because they say investing in early stage founders, you're finally investing in the founder and not in the business, because the business doesn't quite exist, right? So it's totally a function of understanding, and it's a very deep psychometric where they assess founder capability. In India, we don't have those models as yet, but people do use the experience and non-tool based ways to assess your ability to execute. Of course, getting technical advisors also to assist them in making that assessment. And then, so we've discussed some of these issues, but one of the key issues on the risk and uncertainty is there's no historical data. There is really no sound forecast of cash flows. So, let's move to the next slide right now. Yeah, so I think we've discussed many of these factors. I'm literally like a roundup. If you have revenue, what is the unique value proposition? How are you going to save the world? How are you going to actually solve a problem? Is that problem worth solving? How are you solving it better than anybody else out there? What is the IP? I think we've discussed many of these factors earlier. What is the funding environment? That is also becoming very important. What is the investor sentiment? if founders, I mean, investors like us also look at social impact, saying how do you measure impact? But impact is almost table stakes for investors like us. On top of it, we are also looking at returns. So in general, impact is a given, and then you're looking at returns. It's not the other way around. You're not saying just because there is social impact, we should have muted returns or less returns. So let's move to the next slide. And there are various methods. I've touched upon transactions comparable because I felt it was possibly one of the important ones for very early stage startups. But there are people use a combination of methods. You can move to the next slide. I think I've discussed the VC method, which is a scorecard based approach. They use multiple methods of valuation and then kind of come to a number where you're looking at the future cash flows of the company. I won't touch upon this a little bit more because there's more time needed on this. We'll move on. Of course, and you know this, if you've been raising funding, you know what are the questions venture capitalists or any kind of investor, not even VCs, but even angel investors ask. So what I've tried to do here is just list down the most important questions, which help them determine, assess, as a jury, assess the value of this gem that you're showing them. And so let's look at these questions in the next bunch of slides. We'll quickly just kind of round up on that. What have you learned from early versions of your product or service is a very important factor. I'm just highlighting some of the really big questions here. What have you learned? And what have you done with that learning in terms of changing also shows your adaptability in changing things very quickly and very fast as you get your test and learn results coming in from the market. Let's go to I'm just highlighting some of the key things from here. Let's move to the next slide. I think we've talked about this, the market and growth strategy. The most important question here is, how is this capital going to be used? Is this capital going to be deployed in a manner which is going to be most beneficial for the growth and the value of this business in the next 3 to 5 years time? And do you have enough capital? If you're not raising enough capital, then that's a red flag. It means that whatever capital I do invest in will also come to naught because your ability to raise the next round of capital might also be in question. So raise enough capital for your run rate to be able to build that value. And, and what are your month by month, milestones? And not those milestones are not number milestones, about what are the things you're planning to do. What is your process you're doing month on month basis over 18 months, 24 months is a very short period of time in a startup's life cycle. Things happen very fast. So that clarity and that confidence, to anybody assessing your business. Let's move to the next slide. Of course, who are you as a founder? We've had a conversation on this in the earlier part, so I won't touch on this further. Let's move. But what's the team you're creating is also an important aspect. And of course, what are your unit economics and what is your articulated exit strategy for investors? Where are you seeing that? I think it needs to be part of your pitch. Let's move. Okay, I thought it's important to talk about this. Is everybody familiar with safe notes? Are you clear about this, or would you like me to spend a minute or two talking about this? Just give me a yes or no in the messages. I'm trying to see the messages coming down. No. Okay, so I think this also is another approach, Umesh, to your question. And that's something we have used in making 2 technology investments ourselves, which are very tech. And they're not even deep tech, but they are AI tech. I don't know what, that. So what happens is you have no idea whether this is going to work or not, right? Even I don't have any idea as an investor whether this is going to work or not. So this is a pricing methodology which was developed by Y Combinator, I think in 2013, so more than 10 years ago. And that's an approach a lot of us have adopted here in India. Safe notes means simple agreement for future equity, which means that today I have no idea how to assess and value your business. So I'm going to get into, and also we need to make a quick decision. I like you as a founder. I believe in you. I like what you're doing. I broadly feel this is going to work, but I have no data. I've got no data. I'm flying blind out here. So the idea is promising, but there is no really clear revenue stream to determine your valuation. So the investor will provide the required capital, so that's the important this thing. You need to know, okay, I need 1 crore for the next 18 months of operation. So the investor or the bunch of investors will provide the required capital and convert, but that capital is not already equity. It will convert to equity at a later stage. And that later stage would be your next round of funding when you are actually able to value your company, which means that you have X number of customers, you have so much stable revenue coming through, and then you can apply DCF and various other ways of doing the regular valuation. So there are 4 types. I've not covered the fourth one. I'll explain to you why, but there are 4 types of valuation. The first is, today I will put in 1 crore in your business, right? I have no idea if 5 years later and that 1 crore, I'm not saying it's a 10% and therefore your business is valued at 5 crores. Nothing. I'm putting in 1 crore. In 3 years' time, when you're raising the next round, right? I will put a cap at saying that in 3 years' time, I will put a cap of saying I will not, the valuation cap is at my value, because I was an early investor and took a big risk on you, will be capped at 5 crores. However, you might have been able to build something which will value the business at higher than 5 crores, which could be 10 crores, right? So, but me as an early stage investor have the advantage of capping your value at 5 crore because I was an early stage investor. So it gives me a 50% discount to whatever anybody else is coming at. I'm guessing that's clear, but let me just elucidate that a little bit further. This is really used a lot in tech, early stage tech companies. But there's also a downside. The downside is that I might have put a cap of 5 crores, but hey, you might have actually failed miserably and not even built something worth 2 crores. But that is my downside to take, and therefore there are certain terms built in and saying at maximum or cap of 5 crore or lower, right? So that also kind of protects the investor. It should be kind of saying the maximum I'll go up, but the upside helps a lot, saying that you've built something fantastic and you've been able to take that I, as an early investor, I'm at 5 crore valuation, but somebody else comes in at 15 crore. I get a fantastic advantage because I get more value of your firm. Okay, so that's the first. The second is more or less like a similar thing to that, which is more like a discount on the next round of valuation. So whatever be your next round of valuation, I don't even have any idea कि 5 crore का cap रखना चाहिए कि नहीं, right? I don't know what you will value this at in 3 years' time in terms of what you will build, but whatever you value it at, and that's a very popular method that we use here in India, whatever you value it at very early stages, I will take a 30% discount to that, or 20% discount to that, or 50% discount to that based on your ability to negotiate. So therefore, as an early investor, I have the advantage. I've taken the risk. So when your next round of investors come in, I come in at an X discount. And then there's a combination of both, saying I will put a cap of 5 crore and I will get a 20% discount in your next round. So that's more like a variation of the same. The fourth is not very popular. It doesn't quite work, which is called most favored nation status, which means that no cap, no valuation, whatever the market. But I don't understand that method, frankly. It's not very popular here. So just stay with these. Yeah. So I think we'll stop. That's what I'm covering on Safe Notes. If there are any questions or doubts, please let me know and we can discuss the same. Let's go to the next slide. Okay, so broadly, we have covered terms like pre and post money, dilution, cap table, safe instrument. We've not covered this area of registered and merchant banker valuation because, but if anybody has questions, please let me know if you are interested in knowing. Otherwise, I won't cover it. And we've covered the transactions comparable method. So let's move to the next slide. Okay, I think we've come to the end of the deck. So now we can start having a conversation. So how does this work? Are participants allowed to talk, or should I just look at the notes? Felicia, Anthony? So I'm assuming, okay. I'm assuming that we just look at the notes coming. Okay, so I think my understanding is that you can put your comments or your thoughts in the chat message and then we can take it up. In the meanwhile, I would like to read on what Swapnil has shared earlier. Okay, so the question I have for Swapnil, but that perhaps needs like a voice conversation, is how are you different? Okay. Then perhaps we'll talk about this. I think, yeah, we can schedule. That's something I'll leave to the team to come back on. Okay, so how should value calculation be done at the initial stage? I think we've already answered that, hopefully. We are a non-profit. Rajiv is saying we're a non-profit, recently incorporated private limited company. I want to go to valuation. Okay, how do you go it? So Rajiv, the example I want to share with you is of one of our portfolio companies called Kadam Heart. They actually followed a similar trajectory. What is your company about? Could you tell me a little bit? Then maybe I'll context it better. What exactly is the product or service for the private company that'll make revenue? So while you answer that, I'll just tell you the story of Kadam Heart. So the founder was a non-profit leader, and she, for the longest time, had been running a non-profit organization. After she met us, and she had also started a for-profit arm because she realized that the non-profit, the sustainability of the impact of the non-profit would become deeper with the launch of the for-profit arm of their business. We as investors put in money in the for-profit arm of the business, which transitioned to becoming a company so that they could take funds from us. So that now the thing is, how did we get around that valuation? What we followed at that point in time was there was already a certain stable revenue coming in. And we also worked very closely with the founder to develop a 3-year business plan. Using a balanced scorecard approach, a very systematic 3-year business plan was developed along with the founder. As we developed the 3-year business plan, we arrived at a certain trajectory on what the business would be delivering in revenue in 2 to 3 years. Not a very long time, 2 to 3 years time. So before we invested, this founder was doing 5 lakhs of revenue a month. So sorry, I'm just looking at your answer. Social impact organization, bags with an alternative solution. Okay, interesting. So before we came in as investors, this founder was, for the for-profit arm, was doing 5 lakhs of revenue a month. Post investment, which means post capital, was there, and we also put in much more effort in terms of helping the founder develop the team, capabilities, etc., etc. Over a period of 9 months, that 5 lakhs a month became about 25 lakhs a month of revenue, right? And we started seeing the signs of is this really meeting the trajectory that we had planned to build. But anyway, what we had valued at that point in time was on the base of the future cash flows and future revenue of the business, which was, and we valued it as of the future revenues about 3 to 5x of the future potential revenue. But we were taking a huge risk, and it was 3 to 5x only because it was a non-tech products company with zero, right to succeed at that point in time, because they were a brand. They were not really a brand, but they were a known entity. But they're now building the brand. It takes 10 years to build a brand in India. So you are not able to really value the what are you valuing then? You're not valuing any brand value, and nor do you have any solid IP. But all you have is a certain promise on the roadmap to execute. So I hope I've answered this. Actually, Kadam does basketry based bags, just for your information. So I hope I've answered your question. If not, please let me know if there's a further follow-on question. Okay. So when you say a deforestation initiative to replenish the damage created, who is your customer here? Okay. Your customer would be the end consumer, but you're replacing paper. Okay. Okay. So your customer is the end consumer. So it's a similar example. So we followed that method, but also the founder's intention, actually the founder's decision to partner with us was also important in determining that valuation. She did believe later that she diluted a lot more than she should have. She believed that a year down the line. But prior to the funding, I think I think that sense of how are we going to take this business from doing 60 lakhs of revenue a year to becoming a 5 crore business a year was not so clear, you know. But as we pushed through the execution, it became clear. So the more confident she got, the more there was clarity. So my advice here also to you as an early stage founder is try to see if you can defer your funding till you've built a certain substantial revenue base, because then you can value your own personal confidence in the valuation will come in better. That's my recommendation. So you're embedding seeds in the covers of the writing products. Okay, I understand. I have been personally a consumer of these products. Okay. Paper. Oh, so the paper-based products with seeds, so that these seeds can go back in the ground for deforestation. Okay, I get that. It's totally a function of, then I would look at your market size, saying what is the addressable market size of conscious consumers, what is your market access, what is your go-to market, how easy is it for consumers to find you, and how much money do you have to spend for consumers to find you. That builds your unit economics. So there are all these factors, many factors that will go in and determining, and therefore the believability in your business model and your business plan. So if and I'll give you an example of a fantastic go-to-market, right? There is one go-to-market I came across in the basketry industry. I'm just drawing a parallel with that, which focused its entire energies on building one big customer in ferns and petal. And they have built a fantastic base of regular recurring revenue, profitable revenue coming in month on month, and scaling up and growing. That approach to building a business in this sector could be, in the short term, far more value accreting compared to trying to develop a D2C brand, because building a brand is very capital consuming and time consuming, and it needs you to be and you need to have deep top pockets to do that. So how can you find a way to build it to a certain level of revenue which does not need too much capital? And a B2B approach might be an interesting approach to build it to a certain level. Then in 2 years time, when you have a substantial revenue of 50 lakhs, maybe a month, like a monthly run rate coming through, it becomes much easier to raise capital, because you are already generating cash and you can keep investing it back to build a larger consumer base and building a brand. I'm assuming you would like to build a label or a brand behind your product range. Sorry, this is a one-way conversation like this. A dialogue will be more useful, but I'm sure we can find out a way to do that. Okay, understand. Great. So I'm just going back to your throw to grow. I'll look you up. And in fact, we could talk, because it's an area of interest to us in terms of circular economy, consumer-driven products. So as Hearth Ventures. So having So Rajib, I hope you're satisfied, or we can move on. Okay, great. And the question I have earlier from, I want to ask Umesh if he's still around. I want to ask Umesh if he's still around. I don't think he's, I'm not sure. Uh, is there any follow-up question from the conversation we've had so far? Okay. If you have, okay, great. Thanks, Umesh. Do you have anything that's on your mind right now that you'd like to discuss? Okay, great. Thank you. And just to acknowledge, Swapnil, I think the team might be best be able to kind of give you an idea on how to connect next. There was one more gentleman, Anup. Hi, Anup. If you're still there, okay. Nice to meet you. I thought there was a question, but that's fine. Okay. Yeah, I think Rajib, the team might be able to advise you better. Umesh, I am not an expert on IPs, but I think there are enough advisors out there who we can get access to who can advise you. So I don't think I'll be able to spend too much time on this particular question on patents and IP. Thanks. Okay, so folks, I think with that, I think we can conclude the session unless there are any other thoughts. I just wanted to get from you some feedback on the last 1 hour. How worth has it been for you? This just gives me a little bit of more feedback on how to sharpen this as we move forward, if I was to do this again. So thank you, everybody. And thanks for connecting, and good to meet all of you. Look forward to connecting offline on LinkedIn as well. Okay. A workshop on self-evaluation of the company's worth is a good idea for the team. Maybe the RISE team need to make a note of it. And that's a good idea because a really practical hands-on working session where you can evaluate and rate your own self before investors rate you is fantastic. So that's a good idea to follow up on. Thank you, folks. Lovely meeting you.